don't buy a $1.7 million house. Houses are so expensive today. The median house price in Sydney is about $1.7 million, and it's forecasted to reach $1.93 by 2027. For those struggling to buy a house to live in Sydney, what would be the strategy for them?
The strategy is very, very simple. Don't buy a $1.7 or $1.9 million house. Your house should be...
Where do you think property is going to go for 2024?
As a whole, we are going to get rate cuts. Rate cuts are coming, and it's going to spur the market on again in areas that are in demand.
Do you think the rate cut's going to be this end of the year?
Definitely, but here's how I look at property. I look at it like a limited edition car or a limited edition watch or a limited edition handbag. You know, everyone's always talking about those things that are just, there's only this many of them. Cars are my favorite, right? Whatever car you buy, limited edition car goes up in value. Property is the same. We have a limited amount of property right now, but it's in demand. So if you're buying the value, if you're buying all of that, it's a necessity. Housing is the most important thing. You need a roof over your head, and there's a low supply, high demand, and you're buying the value. You can't go wrong. So that's why I'm not too focused on the noise and the media articles and the rest of it. I just focus on the strategy.
What are your top 3 hotspots to buy and why?
Right now, what's going to perform well over the next 12 months is...
Spill the tea time. The information provided in this podcast is for general purposes only and should not be considered personal advice. Always consult with qualified professionals or experts in the relevant field for personalized advice tailored to your specific situation. Welcome to another episode of Catching Up with Property. In this episode, we have Michael Lezaja from Pinnacle Buyers. Michael has over 17 years in property investing. He's been featured in magazines, television, and radio, with one title from 2015 reading, How I Built My $5 Million Portfolio Using Smart Renovations and Diversification. I've worked together with Michael to help a recent client, and I can say his specialty is in seeing value where no one else sees. This episode is for investors and those on their investing journey. Turn the volume up, lean in and listen in as Michael unpacks his secrets. Listen or watch to the end as Michael spills the tea. So, Michael, welcome. Tell us a little bit about yourself and Pinnacle.
I'm a property investor, first and foremost, and always wanted to, growing up in Western Sydney, we didn't have a lot, and always wanted to make money. I had a thing for cars and anything that goes fast and costs money. So, I bought my first home. And really started to follow a lot of the TV shows and learn about property investing, and then started going to seminars and learning about it, and that's it. So that's pretty much me. And then bought a few properties, and then in 2013 I bought 14 properties in 12 months to add, and that added to the 3 that I had already. Property was just came naturally, but it was one of those things where after I bought my first home, I realized quickly I paid $380,000 for my first home in Ingleburn. In Western Sydney. And that was a lot of money back then. and the people I bought it from paid $170.
And now it's cheap as chips.
Now, geez, I'd love to go back and buy more. So and then I realized, I was like, these people bought it before me, and it was $170,000, and they just made $200,000. And I was like, wow, next boom, I'm going to buy heaps of properties. So the next time Sydney booms, I'm going to make money.
And you're just going to double.
I'm just going to double my money.
Double.
That was the light bulb moment for me. And and real estate's my chosen vehicle. I did lose money in the stock market once upon a time, so I'm a bit sour with the stock market. I've never been back since.
They always say you're either a stocks man or a property man.
Oh yeah, definitely. I know which side I'm on.
You swing very strongly one way.
Definitely, mate. Definitely.
How did you achieve hypergrowth? You have that one beautiful title. I researched. You hit $5 million in your property portfolio by 2015. So guys, if you're thinking about this, or if you're listening to this, 2015, $5 million property portfolio would be massive.
In 2013 money was very, very good. It's a very good achievement. There was less rules around servicing with the banks back in 2013, so you could get away with a little bit more.
He's talking to an ex-banker.
So it was a little bit easier for me to get the finance. Funny thing is, I am of the view that property investing is easier today, but I'm saying that from an experience perspective, and I think the kids today have it easier. But that's what I'm going to come back to. We'll come back to that. But yeah, so the hypergrowth, essentially, we'll come back to it. The hypergrowth comes from buying value and seeing value. So buying properties that are under replacement value, so less than what they can be built for again in today's money. Also buying under market value. So if you're buying a $300,000 property, you want to pay $250,000, you want to pay $220,000. Now obviously I'm referring to my portfolio. In today's money, there's not really many $200,000 properties, but you are essentially looking for that under replacement value as one of the biggest indicators of value. Then buy whatever it is at whatever market value that sits at, like price point. You want to pay less, and then you want to have the ability to add value. So let's say you paid less because it does need carpet and paint. Two of the best, or flooring and paint, right? Two of the best things you can do to add value to a property. So you can go back to your mortgage broker and say, Mr. Scotty, where's my money? Where's my money fucking?
$60,000 for you.
So yeah, that's it. So just look, buying value, buying under replacement value, buying under market value, buying high yield as you can, and adding value. So that X factor, as much of that X factor as you can buy, that could be turning a 3-bedroom to a 4-bedroom. That could be buying a house that, might need a bit of a renovation, but it's also got a subdividable block on it. So, no easements, got side access, you could, battle axe it or whatever it is. You're always creating value. Not just that
manufacturing.
Exactly. Not just that standard type of investment property where you can't do anything with it. The one that's been cut up by the developer into a 300 square meter block, you can't do anything with it.
Yeah.
The developers made the money there.
You can cut the grass.
That's it. Cut the grass. Buy it on depreciation. And, we're not a fan of depreciation.
Yeah. So I guess those, what do you call them? Rules or philosophies or?
Non-negotiables.
Oh, they're non-negotiables.
They're non-negotiables. And I think,
So buy under market value. Buy under replacement value.
Yep.
And replacement value would be pretty high right now.
Oh, yeah.
In today's market with building costs.
Melbourne. $450,000 properties. So yeah, it's there, and high yield and that X factor.
And then anything you can do to not manipulate but improve the yield.
Improve. And that's that little, that freshen up of the flooring, the paint, and adding something. I'm also a big fan of adding a shed.
You were telling me this.
I've told you this before. Yeah. So if you don't want to go down the granny flat route and you don't want to pay, your council contributions and big money for a granny flat, you can throw on a 3-car shed. And this is maybe the now Queenslander in me speaking, right? 3-car shed. Maybe it's got a kitchenette and a bathroom in there. They'll love that. Queenslanders love that sort of stuff, right? I'm not saying it's going to be used for any other purposes as, more than a regular garage, than a shed. But, they're there if someone needs to use them. The amenities, right? You can't have enough amenities. So it's adding value, but spending a minimal amount of money. So it's always about spending as little as possible to achieve more of an outcome, to raise the value of the property and to get a better yield.
Wow. I love it. And these are non-negotiables you can use. Last year you could use it 10 years ago, or you can use them 10 years
Hasn't changed.
in the future.
Hasn't changed. So anyone, that says, oh, it was easier back then or it's different now, this is how you invest. Yep. And if you're not doing this, you're essentially slowing your growth. Yep. You're going to grow your portfolio slower. The reason for the 14 properties in 12 months that I bought is because I did these.
Yeah.
And then took the money off the credit cards as well. So there's a whole bunch of strategies, right? But the fact is the non-negotiables are still the same today, and they are what I use with my clients today, and that's not going to change.
Yeah. Wow. And so if somebody's buying a property now, should they be considering of keeping some of that deposit available for that quick reno?
LMI? You want to talk about LMI?
I'm not a fan.
Yeah, you're not a fan.
I'm not a fan.
No. So you've invited me on your podcast, and I'm about to.
He's going to roast me.
Okay. I love paying LMI. Pay your tax. Get your serviceability, pay LMI, leverage. When you're studying it in your portfolio, and the reason I got to where I got to and achieve those things were from leverage. And it was LMI. Anytime I could pay LMI, I paid it just to acquire the asset. And it's even more important to use LMI in a very high inflationary time, such as, post-COVID, because you are benefiting so much from being in the market, right? So whatever that, $5,000, $10,000, $20,000 LMI is, it's the cost of doing business. Do it, get the asset. You're better off controlling having the asset than not having it and waiting to save that 20%. Scotty?
So his argument is the more you acquire, the more it's going to grow.
The more wealth you create.
Yeah.
Because the goal is to control as many assets as possible. The more assets you control, the more it goes up in value. And anyway, I could jump into a stock market rant right now about how you can leverage in real estate, but I won't.
And then my argument is you don't need to go into LMI. Keep your borrowing power. Keep it within that. And then get a good buyer's agent who can help you find assets within the range.
I'm 100% in agreement. Get a good buyer's agent. Get a good buyer's agent for sure.
So I think we covered the next question, but what are some of the smart renovation techniques you recommend? So we covered, paint, flooring,
Yep.
adding a shed. Anything else?
So I think, look, renovations are incredibly important, and a lot of people do renovations in the wrong way. So they overcapitalize and they overspend.
Yes.
So with my renovations, the way I do it, on our last one, I actually did paint myself over 2 days. And a couple of dead set. I called in some favors and we renovated. And it was the cost of paint, right? It was the cost of paint, brushes, and so on. And
brushes, guns,
and beer. And I had to pay for beer because you can't have people doing you a favor without having cold beer. So so that's how we did it. And then kitchen was $5,600, and that was a Bunnings flat pack, and then plus installation, cheapest stainless steel appliances you can get, and then $3,000 was for the floating floorboards supplied and fitted. Super cheap. Freshened it up, didn't do the bathroom, but there was a house in Logan, and it was super cheap, and that's how you should be doing it. But to go and pay exorbitant amounts for 20 grand, like a 20 or 25k kitchen for a Logan property, is very, very wrong. And this is where people are losing money in their equity, and that's why this isn't sustainable. You're overcapitalizing, right?
Yeah.
So we're very, very savvy. Don't get me wrong. I know how to spend money. I can piss up money really, really well. But when it comes to my renovations and that, I'm very meticulous on how much I spend.
And how much do you think that 10K added value to the property?
With a good buyer's agent helping you buy under market value, you want to try and get as close to your next deposit as possible. Add a 10% LVR. Use your element. So
the next question is, let's talk about value. How or where do you identify value in a property?
This is a great one. I was just going to show you an example before we jumped on, but we're about to buy one for a client. So right now we're looking at all of these properties in the Melton region in Melbourne. There is a 3-bedroom that we found. It's about 10 years old. It's a 3-bedder. It's on a smaller block. It doesn't really have...
Did you say 10 years old?
About 10 years old.
Yeah,
it's fairly new. It looks like you wouldn't know it's 10 years old. It's probably newer. It's probably 6 years. But it's $450,000. Purchase price for $450,000. You can't subdivide, cut up a block, pay for civils, council contributions, and develop that. Then the agent sales, and then package it with a house and land package and sell it, and construct it all for $450,000 in today's money, in post-COVID dollar value. You can't do that today for $450,000.
Can we just pause for 1 second? Rewind. Melton, Victoria. $450,000. Hello, Sydney.
Sydney, you're getting ripped.
$450,000 for a house.
Yep.
Yeah, hello.
Yeah, good data set too.
You can't even get a unit here for that.
Good data set too. Exactly. So it's one of those things where you look for value. I love to buy houses that are in pre-COVID money. So everything else has moved. So I was doing the same in Queensland. So
pre-COVID money meaning it's worth what it was
pre-inflation.
Before.
Yeah.
Wow. Okay.
So I'll give you a perfect example. In 2012, there's these 3-bedroom townhouses that were built in Brisbane. They were sold off the plan for $355,000. So 10 years later, in 2022, I bought a heap of these for my clients at $350,000. So 10 years, these properties did nothing. Obviously, Queensland booming. I spotted the value. Houses had already gone up. So quite a few of my clients didn't have the budget to buy $600,000 or $550,000 houses, but they had $350,000. So what I did was I bought the townhouses, 17Ks to Brisbane, that are only 10 years old for the same money that the people paid for them off the plan 10 years earlier. But in post-COVID money, after construction costs were up 50%, we bought them for 2012 money. And they went up like that, 200K, 2 years, right? Because the demand's there.
Anybody see the value in that?
Once again, spotting value. It's all about value.
Anybody see the value in that?
It's all value, my friend. So we're doing the same right now in Melbourne. Data set is great.
Yeah.
And it's in recovery. And now we're picking up the value once again. And you won't be able to buy. See, you can't go back in time and buy properties for less money unless there's a crash, which there will be a crash at some stage, right? We could talk about that. That's another topic I want to talk about as well. But a house and land for $450,000 can't be replaced for that money. It's a $600,000 replacement cost in Melbourne right now. And so to buy for $450,000, it's cheap.
If somebody is like listening or watching this at home, how can they find that information? Like as in like the past data?
Oh, so I'll give away my secrets. So
You don't have to.
Yeah. Get out there. Use realestate.com and find the value under $500,000. Then get a hashtag. Actually, I've got a discount code for hashtag as well, which we can share with everyone at the end. Jump onto hashtag, right? And you can literally do the data analysis the same way I do it. And you can do that and find out where the next hotspot is. And you combine that with the under replacement value metric and then go buy well. And buy that, house, try and get it a bit cheaper, make that instant equity on the way in, and you're set.
Under replacement value. Under replacement value. Under replacement value. Just in case if you didn't hear it.
Yeah. Never fails.
That's a really great gem, and thanks so much for unpacking and sharing some of your BA secrets. For most people, their borrowing power will cap out at about that property 4 or 5. When you were building your property portfolio in the early stages, did you do anything differently to keep acquiring?
So I was buying high yielding properties. So everything we were buying was 7 to 9.4% in rental yield. That's what I was buying.
Were they regional?
No regional. All Sydney and Brisbane.
Yeah.
And it's all city. But we had higher yields back then.
Yeah.
These yields aren't around today. So you've got to kind of do your best. But also I would make sure that I'd freshen up the property for minimal cost to make sure that I am getting the highest possible yield.
Dollar.
And we use the strategy of making dual occupancy as well, where you'd split the house downstairs from upstairs. You get 2 rents out of 1 dwelling, so that your yield's super high. I think it was 10% yield on that one particular one that I had. So when you averaged out the portfolio, it was 7.4 or 7.5% yield across the board, right? But you need to use those strategies if you want to surpass what the majority of Australian investors are doing today. But also, I used a few tricks like the credit cards and stuff like that. As you'd buy a whole heap of properties, you'd get a $10,000 or $15,000 credit card. And I don't recommend this. This isn't financial advice, but you take that money out of those credit cards and back them with the lending criteria you could put into another bank account and get yourself another loan with another lender. So there's plenty of little tricks you could do and get your loans approved. So that's how I scaled as well. That helped. But then obviously you got to pay that money back, and so I just figured the assets I was buying, the returns I was getting on those assets, and I'd refinance them later, and then I'd come back and pay those credit cards. So definitely not financial advice.
Definitely not financial advice. And credit cards is a double-edged sword.
It is. It's a dangerous one.
You take it, you use it, and it impacts your borrowing ability. So.
It's changed now, hasn't it?
Yeah.
Well.
Yeah, so high yield. And then when you were talking about cutting up the, adding extra rentals into the single property, would you be doing them as council approved or
council approved? Okay. Yeah. You a private certifier.
Yeah.
Yep. You can do them non-council approved, and I can promise you this: there is so many non-council approved auxiliary dwellings, patios, extensions all across the country. Like half the country is not approved.
Yeah.
So it's out there. But no, I obviously used a private certifier.
Did it by the books, but the smart way.
Good private certifier, hard to find.
So generally, when I'm buying real estate, if I'm buying resi, then I really want to buy a house and a land. I'm not a fan of paying strata, so I really don't like units or studios or townhouses, because I really feel like strata expense is a waste, and it does impact your borrowing ability. Do you have an asset bias?
I don't, but I do want to sit here and say that you can buy units. Not my preference though. It is my last resort, but there's a way in which you can do it at the right time of the cycle and make it profitable when you buy the value. I've got heaps of these examples.
I'm leaning in now.
I've got heaps of these examples. So you can buy units and be successful at buying units. You can buy townhouses. You can buy houses. Obviously, preference for houses. and the preference for a house that I could change into a dual occupancy and one that I could also subdivide. So it's got that X factor. That's my preference. I love that. I think that's the best. They are super hard to find now. You know, they're still out there. Like yesterday, we found a development house for $400,000 in Melbourne, which you could knock down and go 3 stories for 400K. So the deals are out there. You just got to find them. So that's obviously my preference. But I built a lot of my portfolio on townhouses. And why would I say no to a townhouse? If there's limited supply, make sure your building approvals are limited over the next couple of years. Do your data checks. Like I said, hashtag's fantastic for that. Check your data. Make sure there's no oversupply coming. You can buy these assets as long as you do your body corp checks, your strata checks. Make sure that it's, it all looks great. Try and stay away from elevators, pools, all of those added, those expensive complexes. As investors, they don't make sense. I like to buy the smaller ones. So, for example, six pack, 8 pack. Thank you. So
red or brown brick.
You've been watching my videos. So buying those 6, 8, 10 packs in Surfers right behind Surfers Paradise. They've all been rezoned. And you're buying that complex, there's no pool, there's barely any parking. There's like no amenities whatsoever. Strata body corp is low, and you're buying land that, can be used in future development. So those sorts of units are great because if you don't have a big budget, you can still get prime real estate.
Yes.
With a land component attached to it. So that's the sort of units that I like, and buying them at the right time of the cycle. So for example, in Brisbane, after houses went up, I said to a lot of my clients, hey, houses have moved. We can either go to Perth and buy houses now.
Moved as in it's gone to a point where it's unaffordable?
It's gone to a point where it's moved so much that I want to try and buy I'm always looking for the next thing that's going to go up. I'm looking for the next thing that's absolutely at the bottom, that I could see it's going to go up, it's going to make money.
Bottomed out.
The data aligns. That's what I like. So then I said to my clients, hey, do you want to come and buy a $300,000 house in Perth? Or you can buy a $350,000 townhouse in Brisbane. I gave them that option. Some of them came with me to Perth. Some of them bought the townhouses. Both succeeded incredibly, whichever way you went. The color of money is the same. This is what people keep forgetting. Whether it's a unit, a townhouse, it's a freaking caravan in Darwin. It is a house with the X factor. The color of money is the same. Profit's profit anywhere you go. So I like all of it, and it depends on what time of the cycle it is and what you have to spend, where you want to invest, what the data set looks like, what the supply looks like, and how the demand looks as well. So it's all a combination of strategy, and I think experience is the key. And if you need that help, a good buyer's agent will know all these sorts of tricks.
Well, you'd expect them to know them.
Well, you'd expect them to know, yes.
So sounds like it's when the market's kind of...
Don't be biased, Scott.
Huh?
Don't be biased.
I like being biased. I like leaning to one side.
Stop your bias.
Oh, my hair leans on one side too. Are there any properties you would simply say no?
Off the plan units.
Off the plan units.
Off the plan houses.
Yeah.
Yeah.
Okay.
Yeah. Unless you're doing something unique with that off the plan house.
Yeah.
And it's a rooming house or it's something that's
totally
and even then you got to be cautious of all of those. I'm not a big fan of a lot of those.
Are you a fan of NDIS?
Of schemes? I'm not a fan, no. Are there a select few making money out of it that know the game in and out? I don't doubt it. But is that something generally I would suggest that people do? I'd probably steer away from it. Yeah, but off the plan houses, standard houses off the plan, standard units off the plan. Someone's already made the money. You want to look, once again, we come back to value. Whatever you're doing, you need to spot value.
You need to take the value or create it.
Or create it.
If you're not taking it, you're not creating it. You're paying somebody else's value.
Exactly. Exactly. Everyone's got to make money. Everyone makes money every step of the way. You want to be the one making the money, not the developer. Developers have enough money.
You'll be the developer.
Yeah. Developers have enough money. Yeah. Get your money.
Flip side of that, what are the things that makes you go, hell yeah, I'm going to buy this property?
I'll give you a couple of examples. Most recently, houses that look like a mess.
Oh, I like that.
So as a buyer's agent, I will often call agents and say, listen, the houses that no one wants to buy, the houses that have termites, the houses that have mold, that have problems, that have, the roof's falling down, it's had a fire, structurally it's moved, whatever those ones are, normally, I want those. The ones that don't have appeal to the majority are the ones that I want, because I see a way in which I can obviously solve the problem by, buying it, fixing it and making money. Yeah. But I buy the property for someone who doesn't want to fix it. Now, obviously the person that has that property can opt to renovate it themselves. They choose not to. And if I'm going to do the renovation to add value, well, then I'm going to need a little bit of profit for my time. So I like that, because that fast tracks your portfolio. And that's how people grow portfolios super quick, is by buying that value and then creating, that bit more. So
often, actually quite often now, I have first home buyers coming to me wanting to purchase their first home, but they're torn between buying their first home or buying their first home as an investment. What are the tips for a first home buyer wanting to build an investment property portfolio?
I'm going to give you an interesting perspective. If you can look, you should be reinvesting for serviceability. Okay. Yes. You happy with that one?
Yes.
But if you are going to, and if you are going to go the principal place of residence, try and go the development potential. So by this, I mean, okay, don't go, if you're not going to go buy your investment property and you want to move into it and, you're a little bit handy, buy an old house. Buy a house that's at a discounted price where you can work on it over the course of the next couple of years, because whatever you make from it, it's tax-free. It's a principal place of residence. Try and add value to it. Buy it on a subdividable block. Like if you can do stuff like that, if you're not going down the investment path, buy that principal place of residence that has that development potential, or that has some kind of potential where you can manufacture growth from that property tax-free to get you into your next property, or to refinance and go buy and build your portfolio later on. That's the best way, I think. Don't just buy a standard off the plan house and land.
That's gold.
It's a typical answer you'd expect from me, though.
But just going back to tax-free, we're specifically talking about capital gains tax.
Capital gains tax, that's correct. Yeah.
So houses are so expensive today. The median house price in Sydney is about 1.7 million, and it's forecasted to reach 1.93 by 2027. For those struggling to buy a house to live in Sydney, what would be the strategy for them?
The strategy is very, very simple. Don't buy a 1.7 or $1.9 million house. Your house should be somewhere between 800 and 1.1. And that's exactly the first house that I bought now. It's probably worth 1.1 today. You get your P's and you're buying your first car. You don't go buy a Ferrari. So hang on a second. Or let's say, average median car price might be $33,000 or whatever it may be, for example. I never bought a $33,000 car. I bought a $700 car. So that's how you start. Everyone starts somewhere. And I think on a principal place of residence, if you want to live, you got to be careful about overcapitalising and weighing yourself down with a lot of debt. When you're starting out in life and, it's your first home and you're young, you need to be investing. So I would really keep it minimal. And if it is a 2-bedroom apartment in Lakemba, then so be it. Not ragging on Lakemba.
Hey man, I grew up there.
So you get my point. It's buy something that's within your means, and a lot of us aren't born with money, so just be wise.
Don't buy a $1.7 million house. So how do you help someone build out a portfolio? How many properties do they accumulate before selling down?
Well, how long's a piece of string? It's one of those ones where how much do you want?
As much as I can have.
How much do you
You bring me to the candy shop, I want it all.
All right. So if a lot of people have the whole, $100,000 passive income. The $100,000 passive income.
I want double that.
I know, because that $100,000 passive income was talked about like 10 years ago. And I was like, yeah, I get $100,000, I'm cool. Now $100,000 doesn't
I think
cover anything.
$100,000 is like the medium income now.
Yeah. So you have $2 million worth of assets. So you accumulate enough assets to sell down and have $2 million unencumbered. And if it's at 5%, that gives you your 100,000.
Oh, so we're still working on those formulas.
Yeah, right. But 100,000 doesn't work unless you're incredibly frugal and you know how to, and you got your home paid off already, and then you got the $2 million in extra assets, and you got $100,000 passive income on top of owning your own home, your own car. That's all well and good, but the whole $100,000 retirement is $100,000 per annum. So passive income is not as good as it used to be. It doesn't sound as good as it used to.
Yeah, absolutely not. I'm probably like $500,000 now.
I reckon if you got to $500,000, you'll want more. You'll say, you know what, 600. I like 600. How long do you reckon till we get to $1 million?
So let's put this in real terms. So if we're working on $2 million in assets owned outright, so how many properties would that be?
$2 million worth of assets owned outright could be 4 properties.
4 properties owned outright.
Yeah.
So when you're building out a portfolio, let's say you can acquire 3 to 4 properties, which is probably on the 4 and 5 is probably the stretch mark for most.
For general serviceability. That's why we need to, I think it's crucial that everyone buys their first and second and third very, very well. I think your portfolio, it's made or it's broken with your first purchase. 100%. This is where a lot of people are going wrong. And the majority of investors are buying the wrong ones because they're being told. And once again, hopefully no financial planners or advisors or project marketers are listening, but a lot of the stock that these people are recommending that the general population buys in order to save tax or whatever it may be, whatever the strategy is, they're going wrong. Yeah. That's the reason they're not making the 4 or 5. And that's the reason a lot of successful investors have 10 and 15 is because they're doing it right from the start. So buying high yielding assets is incredibly important to scaling a portfolio quickly and having those value adds in between. That's how you fast track it.
So in my head, it's around 4 or 5 properties owned outright.
Yeah, but your wallet's going to disagree.
Yeah,
you're going to spend
by the time you get there,
you're more.
You're going to be like, oh, I need triple that. Spill the tea time. Where do you think property is going to go for 2024?
It's interesting. As a whole, I think we are going to get rate cuts. Rate cuts are coming, and it's going to spur the market on again in areas that are in demand.
Do you think the rate cut's going to be this end of the year?
Yes. Yes, this side.
This side.
Closer to us. Definitely. But I don't focus too much on rate cuts. Like I couldn't tell you what's going on in politics or parliament. I couldn't tell you what's going on in general. I don't focus on it. Yeah. I focus on the value, buying value or buying an asset which is limited in supply. Here's how I look at property as well. And I'm sidetracking a little bit, but I look at it like a limited edition car or a limited edition watch or a limited edition handbag. You know, everyone's always talking about those things that are just, there's only this many of them. Cars are my favorite, right? Yeah. You know, whatever car you buy, limited edition car goes up in value. Property is the same. We have a limited amount of property right now, but it's in demand. So if you're buying the value, if you're buying all of that's essentially, it's a necessity. Housing is the most important thing. You need a roof over your head, and there's a low supply, high demand, and you're buying the value, you can't go wrong. So that's why I'm not too focused on what's on the noise and the media articles and the rest of it. I just focus on the strategy.
Buy under replacement value.
Exactly.
Do we say that?
Exactly. So I'll continue to buy the value, and we're not going to stop with that. I think it's only going to go from strength to strength. I will be advising everyone to be cautious on certain areas that may be dependent on mining or have a large portion of the GDP of that particular area, centralized.
It is pretty dangerous. I've seen in the past, mining towns where it's just, like back in the day, you remember like Kalgoorlie.
Or Moranbah, yeah. Moranbah.
Kalgoorlie was like, went to over a mill and then
and then down.
Crashed.
So now it's one of those times where people have to be super careful. I seen someone talking about it on a post the other day. Should I buy this mining town? And it's like right now with the way things are, going in the stock market, and that if we do have a slowdown, from China, it will definitely impact.
Well, the government reckons the iron ore prices are going to go down. So
there you go. Job layoffs. Property prices come down, and those people from those areas that have been laid off will be moving back to other areas. So
major regional towns or
exactly
back into city centers.
So I'll just be careful of that. But make sure you bind them in. Check the data.
Next question leads on to 2024. Where do you think 2025 is going to go?
2025 is an interesting one. I see it continually growing, but then how do you, okay, I can sit here and put my buyer's agent property investment hat on and tell you whatever you want to hear, but how does it all work? I mean, what if there is a World War III? What if there is crazy? Well, how do you know what's going to happen? You don't. I mean, like, we can sit here and say, okay, the data's telling us, buy here and it's going to do well. That's great. But, data couldn't predict the COVID boom.
Yeah, absolutely.
You know what I mean?
When COVID hit, I was like, the property market's dead. And did the absolute opposite. Everyone's like...
Yeah. So, I think it's going to continue to perform, especially in in-demand areas. Buying below replacement value, under market value, buying stock that is in an affordable price bracket. So we're buying affordable stock under $500,000, under $600,000, right? This is a necessity. This is general housing that people need to live in. This property, this stock can't go down further. So I did a video on my Instagram in 2022 talking about interest rate proof real estate. And it was me talking about, property in Southeast Queensland, which was, I paid $420,000 for it, 3-bedder. And interest rates were going up and everyone was staying out of the market because I think we had 14 consecutive rises. But I was buying this and telling everyone this is interest rate proof, and turned out that way, and it's gone up in value, and it is what it is. But a $2 million house might have suffered during that period of time, and you couldn't have found a buyer at an open home on a Saturday, right? So I think buying quality real estate never goes out of fashion. Buying value.
Well, this leads on. What are your top 3 hotspots to buy and why?
Right now, what's going to perform well over the next 12 months is Townsville. Like, let's not kid ourselves. Townsville's been a solid performer for a long time. Do you
think it's too late to get in?
I think if you're smart, you can buy and not overpay. Buy something that you can add value to and exit at the right time. Because you can time it literally to the week or the month when you exit. You can do this. It's done very, very easily. You can do it. Actually, if we got more time, we should talk about that. But you can do it. Townsville still a go. Parts of Cairns, Mildura. For low entry point value, under 450,000, Mildura is really, really good. Mount Gambier in the lower, it's a lower price
These
bracket.
Are all Queensland.
That's South Australia, Mount Gambier.
Yeah, all right.
Mildura's border town.
Yeah, that's what I thought. I was like,
yeah, which one is it?
But it's so hard to get to.
yes, it is. So Mildura, and I'm big on Melbourne, to be honest. I'm big on Melbourne. I'm big on buying that value. It's affordable. There really isn't anywhere. Like, even, let's face it, right now we're buying $450,000 houses in Melbourne that have amazing data sets. I mean, I did a data set on $550,000 properties and with certain inputs in metrics and with certain filters, and it came up like four of the areas came up Townsville. 4 suburbs in Townsville, 4 suburbs in Melbourne for under 550. Wow. Like, so similar data sets, but Melbourne just hasn't kicked off yet. So it is coming. It's just right there. But now you get to buy before the crowd, which gives you asset selection, which I talk about value. So we don't have to fight with anyone and overpay to get in. We're buying super cheap and then we're buying undervalue, and it's just can't go wrong. So that's my advice.
So 3 hotspots: Mildura, Mount Gambier, Melbourne.
Townsville if you're quick.
Townsville
in and out. Hit and run. Hit and run.
Depends how quick you can be. So
let's keep it about real estate.
This question's not there, but I thought I would just lead on. So we spoke about exiting. How do you time it and how do you exit?
Yeah, so back before all of the data that we've got now, I would just talk to agents. So I'd want to know what's their inquiry rate like, and I'd talk to different agents on the ground, and I want to know their inquiry rate, how many people at open houses, how many offers on properties, and you'd start to get a feel for how the market's doing based on that. So for example, before I learned to analyze data, I would sit, I remember I used to sit with Daniel from Ray White in Ingleburn, and I'd be like, how many phone inquiries you got? And he'd be telling me this many people and this is what's going on. And I'd be like, okay, cool. Things are happening. Things are moving. Yeah. They're getting overs for this property. Okay, it's kicked off. We're in a property boom. And I remember sitting there in February 2013 with him, and I was telling him, we're in a property boom. This is what's going on because of this and that. And I'd just do that.
Yeah.
So everyone's got their own style. Yeah. I learned a little bit on the street and that way, and it seems to work. So I think if you're doing, let's say Townsville for an example, and you can do a hit and run.
I love that, hit and run.
It's my very technical analysis there, my technical terminology. But yeah, you can really understand when it starts to drop off. But we have data, hashtag will be telling us that as well. And then obviously talking to agents, and you'll know exactly how to time it and then just get out at the top. The funny thing is though, I want to warn about the hit and run. Because you can do hit and run, and I've done it many, many times.
And missed the mark?
No. Nailed it.
You don't hit and then you don't run.
No. I nailed it. Listen to this. I nailed it. Here's the thing though. Nailed it. The market's ended up and absolutely exited at the top. You can't time it better. I timed it like that. It was beautiful. Then only 2 years later, you realize the market gets a second wind. Then it goes up again. So in reality, I've exited from the market thinking, I've absolutely nailed this. I've made a heap of money. It was perfect. And it was a thing of beauty. And in reality, I just sold an asset. I've lost an asset or mine less asset. So looking back now, when I did the hit and run on Sydney's gone up way more. Wish I never sold Sydney. So there you go.
So maybe a hit and run may not be the best strategy.
It's
depends what you need in your portfolio.
Yeah, it's up to the person. It's up to the person. But I'm also not a fan of, let's say, jumping in at a market peak or close to a market peak And then what? I've only got a tiny bit of growth, right? And even if that market comes off, it corrects.
Yeah.
So whatever growth I get, it could have a little correction anyway. And then what? I'm going to sit on that for the next, 5-7 years or whatever with no growth. Exactly. Whilst my deposit could be in an asset in another area that is booming. Yes. So there's so much to talk about strategy there. There's plenty of ways to do it.
So when you're looking at exiting, is there anecdotally you'll be talking to agents just trying to find out what's actually happening in the market if things are starting to cool off?
And you'll know markets go through stages. So for example, investors and first home buyers are always there at the start of a market because it's affordable, right? Let's say for example. So once the yield starts to become incredibly low, you'll find there's less and less investors, because the market's gone up a fair bit. So you'll find less investors will drop off. First home buyers may drop off a bit. All of a sudden you get to the end so you start to know that you're at the end of the cycle. Average cycle, I think, is like 33. In Australian history, I think it's averages 33 months for a cycle. So when it starts to drop off towards the end, you start to get those people that are upgrading their homes because they've got a lot of equity. They're like, you know what, let's upgrade, let's get a bigger house. And they tend to round out the cycle. And you know that you need to kind of get out just at the right time, just before then.
Any last messages you want to leave the audience?
Don't listen to anybody. After I've given all this advice, I want to say to everyone, the amount of bad advice that is out there on the internet is we were just talking about it in the car.
Yeah.
But I think some of the worst advice actually comes from family.
100%. That first property I bought in Penrith, my parents.
Okay, what'd your parents do to you, Scott?
They're like, why are you buying in the country?
The country Penrith?
Yeah.
Well, yeah.
There's no one there?
Out there.
I don't know why they sound...
It's funny. That's their
like they're from Lakemba. I grew up in Lakemba.
There you go. It's one of those things, isn't it, where so much bad advice that you get from neighbors, friends, family, and there's so much advice from people that just don't know. Yeah. And we tend to take it, like I get clients all the time come to me and go, "Oh, we had a look at it and I spoke to my mate as well and he reckons we shouldn't do it." And it's like, okay, bro, so who's your mate? Like, what's your mate got to do with anything? Like, since when is he in this transaction? I don't recall signing up, your mate as a client. And how much properties does your mate have? What has your mate done? How much knowledge do they have? And it's like, the guy at the pub said, maybe that's not a good idea. That's not a strategy. That's not, how's that? I don't know. Just people are random.
Listen to the people who have done it.
Yeah, exactly. Yeah.
Those that are sitting on a portfolio.
Exactly. Exactly. We know.
Part of this podcast, Michael's being very, very graceful with his time, and he's happy to give, for the first 3 people that reach out to us, a free strategy session. Michael, you can probably talk a little bit more about what happens in a strategy session.
Yeah, so in a strategy session, we'll take a look at your, your position, what it is that you want to achieve, and your time frame, and how we'd reverse engineer that to get you to your end goal. If you're looking at doing that, first 3, get in touch with Scott, and Scott will pass on your details. We'll do a strategy session where we jump online on a Zoom call. I'll share my screen, and we'll also analyze whatever properties you have in your portfolio. And we can do our hashtag analysis on that as well, just to let you know how that's performing, how it's going to perform, and give you a few, some insight into strategies and what you could do moving forward.
Delicious.
Done.
Thank you. Otherwise, where else can people find you?
PinnacleBuyersAgents.com.au, and you'll find plenty of useful videos and information on our Instagram page, where I'm constantly ranting and raving and talking all sorts of stuff. Jump on there, check it out, and feel free to get in touch.
Awesome.
Thank you.
Thank you for watching another episode of Catching Up with Property. And thank you, Michael, for being our special guest.
Thank you so much
in this episode.
It's a pleasure.
Thank you.
Cheers.
Bye.